Hi, everyone. Welcome again to another podcast with Ted and I. The mission for this podcast is to help everyone become much more financially literate. So don't forget to like, share, and subscribe. Today, we have a really interesting company again we're talking about called Cielo Waste. And this is a company very similar in some respects to another business that we did analysis on, a company by the name of Powerhouse Energy. Now, Cielo Waste, essentially, what they do is they take waste from multiple waste streams and they convert it into what they term as renewable diesel, which has applications far and wide. And what is interesting about this company is that they say they have a patent in technology, but actually that technology is licensed with what they call related party. And that related party is a company called Renewable Energy. Now, what's interesting here, and we're going to stick around because we're going to show you some interesting finances here, but what's interesting is that a research company by the name of Night Market Research actually put this company at a high risk, and they downgraded their share price. And the reason for that, or downgraded the forecasting of the share price. And the reason for that is that they say that this related party, Renewable Energy, hasn't got a decent level of funding, even though Cielo says that they do. So we're going to be looking at their finances to look at those fundamentals. But before I do that, this company came as a recommendation from one of our viewers. So we're getting them fast in. So thank you, Rizzo Co., for your recommendation. And as always, we are happy to help our viewers out. And we've done this analysis for you. Ted, this is a very interesting company, right? I think this is the third company we've come across that had no revenue for the past few years. But it seems like they've made a slight change there now, which we're going to be looking at their interim unaudited reports, correct?
You're absolutely right, Moeed. So welcome, good to see you. Welcome back to all of our viewers. So here we go. Here is Cielo Waste Solutions Corp. This is their financial statements for the 9 months ended 31st January 2021. We're dealing in Canadian dollars. So don't forget, this is 9 months rather than the full year. And these are unaudited accounts. Now, let's start off with the profit and loss account. Here we go. So we can see in the previous year, we had effectively, well, we've got the actual, the company itself, and so 9 months ended, so we're looking at the right-hand section over here. There's this year, there's last year, and you'll see, and this is expressed in Canadian dollars, okay? Not in millions or thousands, in Canadian dollars. Sales are $4,200, okay? That's it, no more than $4,200. And they just say incidental sales. So what they're really saying is we're not really selling right now. And then they put in the cost of sales also at $4,200. So they're not making a profit. They weren't making a profit this year. They're not making a profit. They weren't making a profit last year. So effectively, what we're saying is you're absolutely right. They're not making a profit this year. Sorry, they're not making any sales this year, and they still haven't been making any sales. Meanwhile, if we scroll down to further down the income statement, we can see the costs that they're incurring. So here they are, and we can see that these are all of the costs that are being incurred by the company, which give a total of $4.8 million. Now, interestingly enough, they've mixed a little bit up in here. So they've got, for example, $1 million of interest in there, and that technically should come down after the operating profit. So I've done a little bit of calculations, and I've worked out that their operating loss is $3.7 million. Okay, and remember that's $3.7 million for the 9 months. So that's a projected roughly $5 million for the entire year. And if you're interested in your margins based on their sales figure, I reckon that's about a 9,000% operating loss, but obviously it's meaningless because they're not making any sales. So they do have this significant amount of interest tucked in there, which is causing them a lot of problems. and you've got the costs of running the business, all the sales, general, administrative. They're not actually excessively large here. They've got some management fees, which are from other companies. They've got quite a lot of amortization going on in here, a few bank charges, other bits and pieces, etc., etc. And you can see the salaries as well, and the compensation. So anyway, the point here is that they are operating at a loss. They've been operating at a loss for a while. They're not making any sales. So this is very much a bet on the future. And can they actually deliver on the future? Let's go and look at how strong they are, their financial strength, when we're looking at the balance sheet. So we look in the balance sheet up at the top, we've got our assets, and we notice straight off very little cash on the balance sheet, only $266,000. And a lot of prepaid expenses. So this will have a negative effect on their cash flow. This is stuff they've paid for, but not yet actually incurred. So it's not a cost that is appearing in the income statement, but it is a cost that they've paid for. So this will have had a negative effect on their cash flow. Quite interesting looking at the non-current assets. This line here, well, this is the non-current assets, a big increase from 15.8 to $18.9 million in terms of the property, plant and equipment. In fact, that's such a big number. I think we're going to go and have a look at it and see actually what they're up to, what's going on line 6, note 6. So if we scroll down to note 6, which is where they explain the detail of that number. Here we go, property, plant and equipment. We're on note 6 here. There it is. And what we notice is the big number is this construction in progress. So these guys are basically, they're building their refineries, they're building their facilities. And once they come into operation, that's when the sales come in. So this is very, very much a jam tomorrow story. Let us, fund us to build the facilities. And once we get it up and running, then we will start to produce, and then you'll see the sales. It's a patented technology, etc., etc. We're going to the moon type of stuff. So you've got to have quite a, I'm not sure I'll be betting my betting my house on this company. This is, not for the faint-hearted. Let's put it like that. Not an investment for widows and orphans, as they call them. So let's go back to the balance sheet, see what else is going on there. So we've looked at the assets, and we can see the liabilities further down. Now, what jumps out at me, the liabilities, remember the liabilities, these are the current liabilities. These are amounts that we owe and we have to pay soon. And it doesn't take a rocket scientist to suddenly look at the big number. There it is, accounts payable. They owe $4 million. Now, if you haven't got any sales, where are you going to get the $4 million to pay for those accounts payable? They haven't got the money in the bank account. They haven't got the sales. There's only one place they can go and get it, and that is to raise more finance. So that's clearly going to be their aim. And we can see down the bottom, here's the shareholders' funds, 28 million last year, and now up to 38 million. So they are raising equity by issuing more shares, diluting existing shareholders, and they are burning through and making a loss at the moment. We can see also quite interesting about this company, and not something which we would expect usually for a company of this high risk, is the debt funding. So these numbers here show that they are funded by debt. In fact, actually, not only are they funded by long-term debt, there's quite a lot of short-term debt as well. Okay, so we add these numbers together, we've got, what's that, about 1.7 million of short-term debt, and another nearly 8 million of, certainly 7 million of long-term debt. So you add those two together, there's a lot of debt funding on this business compared with the amount of equity that is funding this business. You'll notice that the funding is divided between what they call the long-term loans payable and convertible debentures. So the convertible debentures can be converted into equity. So if they're not going to get the money back, then they will convert into equity, whereas the long-term debt you've actually got to give back. In fact, these are such big numbers, I think we're going to go and have a look at notes 9 and 10 and see exactly what is going on there. So notes 9 and 10, let me just whiz down to them. So here's note 9, that's note 10. Here's note 9 talking about the short-term loans payable. Now, I'm not going to go into detail on these. They're fairly fairly detailed. But what's quite interesting is it jumps out to me is that they are actually paying 12% annually. Okay, now 12%, that's incredibly high in today's interest rate, low interest rate environment. Now you can argue this is a very high risk company. Absolutely, it's high risk, and therefore it's going to cost them a lot of money to raise that debt. But 12% seems pretty high to me. If we scroll down a little bit, we can see where we go. Here's the convertibles. So the convertibles, we can see they're paying 15%, for example, another 15%. So these are really, really expensive, expensive securities, expensive way of funding the business. And also you'll notice it talks about this prepaid interest. So they've actually got to pay interest up front in advance on the date of issuance. So it talks in this sort of section here on the date of issuance. They're actually 3 years of interest is prepaid, and that I think is where the prepayment of expenses is sitting. So effectively, they've got an asset sitting in their balance sheet of the interest that they've already paid. So if you take on this debt, effectively, you've already received 2 years or 3 years worth of interest, for example. So it just looks a little bit kind of messy to me. I have to admit, I'm not 100% convinced by that, by a company with so much debt, funding itself through debt, paying a very high rate of interest, and then paying that interest in advance. I mean, we almost hardly need look at the cash flow, but we will anyway. So we've got the loss for the period. Here's the amortization going on of property, plant, and equipment. So a lot of that will be the building in work in progress won't be amortized. Come down to the cash used in, and so they've got a cash burn. They're burning about $2 to $3 million in the 9 months. So they've fairly significant cash burn for the year. In terms of the investment going on, just scroll down a little bit. So interesting enough, they've got the investment they've put down here. So don't get this muddled up. They've changed the order for some reason. And then we can see, here is the company being funded. It's being funded through convertible debt and shares for cash. And those are the costs of the issue, for example. So, this is very, very dependent on short-term funding. If the borrowers won't lend any more money, if the shareholders won't continue to fund it, then it's effectively game over. And if you're a convertible debt, there's no point converting your debt into equity. If you don't convert it and it goes bust, you're going to lose your money. If you do convert it, then and the company goes bust, then you're going to lose your money. So in effect, the convertible debt will be sitting there thinking, well, if I don't convert, if I keep the debt and the company does go bust, then I'm last in the queue, but I may get a few scraps under the table when they sell the actual facilities. So, well, this whole kind of situation is recognized by the company. So here is the notes to the accounts. Talks a little bit about what they do, and a lot of information about how it's, that you mentioned some of the deals and the contracts they have with related parties, but also it's worth understanding their going concern, and here the note. The company's operations as intended and its financial success are also dependent upon the successful commercial startup of its renewable, et cetera, et cetera, et cetera. And the company has also been, and the company's access to joint to financing. So they recognize that they need to continue to gain that financing. And if they can't get that financing, then it becomes a major problem. So this comment here, the company's ability to continue operations and fund its expenditures is dependent on management's ability to secure additional financing. So if they can't get the additional financing, then effectively it is game over. And that is written very loud and clear all over this business. I thought we'd just, before we finish this, we just whiz all the way down to the very bottom. So usually right down the bottom is where you find some interesting stuff going on. And here we've got some subsequent events. Now, I haven't been through this in detail, but it is quite interesting about what's been going on. So this is between the balance sheet date and the date that these were actually made public and signed off by the board of directors. Okay, and what's interesting here, so February 2021, they talk about their first significant sale of renewable fuels. Okay, so they're starting to sell. So we'd expect to start to see the sales coming in. They're proving their technology. It is working. People are buying it. So maybe this is actually starting to kind of show that there is light at the end of the tunnel. It talks about a letter of binding intent from one or more lenders who are going to actually continue to fund the business. So that should give us a little bit more confidence, and you know, a few other bits and pieces. But you know, at the end of the day, you know, if I was supplying this company, then I would be incredibly nervous about this number sitting here, this accounts payable number. So if you're an investor, it's a different challenge, but if you're supplying this company, you ain't going to get paid. That's kind of what I'm seeing here at the moment, or they're going to push you really hard on your payment terms. I did a little calculation and I worked out that payment terms for this company were something crazy like 2,431 days, which is obviously not right. But you know, I think they're using their suppliers to fund them as much as anything else. So what does all this mean for the company in terms of its share price? Well, here is the share price bouncing around a little bit. You'll notice, so it's been kind of going nowhere for a while, and then suddenly it takes off, but then drops down a little bit. Takes off early 2021, so maybe there is a you know, an announcement by the company. I don't know, I haven't been following them on a day-by-day basis, but this is clearly a you know, this is a company, there's a big announcement, it's kind of off the boil. Maybe that was the downgrade you were mentioning, Moeed. In terms of the market capitalization, you know, we can't talk in terms of PE ratios because of course there is no E. When we compare that number to the net assets of 7 million, market cap of 440 million, you know, this is, you know, that you can't really kind of, you know, you can't even value it as a multiple of sales because there are no sales. So this is real pie in the sky, finger in the air, discounted cash flow, and we'd have to look at the management projections. But you know, this is a sort of company where if it does what it says on the tin and it shoots for the moon, then you know, maybe you can pick up a bargain. But don't forget, you know, there's lots and lots of companies out there all selling this kind of story. You know, is this one to back? Who knows? So there you go.
Yeah, really interesting. Basically, they need to start making a lot more sales faster. That's the
well, they need to deliver. I mean, you know, it's you know, it's always jam tomorrow. This construction in progress. They need to have a construction which is now finished, and they're actually proof of concept. It's coming out, and people are, you know, suddenly the UK. We read about shipping their waste to Turkey, to landfill. They need to package it up and ship it off to Canada and stick it through this and turn it into fuel. And if it works and it does what it says on the tin, and they've got it patented and it's protected so nobody else can copy it, then yeah, these guys, you know, this is not the last we've heard of them.
Yeah, and absolutely, if you're a viewer looking at this, you know, definitely keep a close eye on this related party, Renewable U Energy, because it seems that they have created this technology in partnership with them. There's licensing involved. So if Renewable U Energy, if something happens to them, that's going to cause a real big problem for Cielo Waste. So absolutely keep a very close eye on that. Very interesting what you wrote there about what you said there about accounts receivable, right? So any salespeople, any business people watching this, if you're thinking about doing business with them or any other company, look at that figure there in the cash flow, in the assets section, the balance sheet section, because that
in the liabilities,
sorry,
they owe you. So if you're selling to them,
liabilities.
You may be able to secure the deal, but are you going to get paid? And don't forget, sales is vanity, profit is sanity, but cash is reality.
Reality, yeah, absolutely. So look at that in the balance sheet portion of the financial statement. Really interesting business, and thank you again. I believe it was Rico for asking us to analyze this company. Very interesting one. I think we're going to see a few more of these renewable energy businesses, right? It's a hot topic right now. And if there's anyone out there that has a particular company you want us to look at, actually, if you have a renewable energies business that you would like us to look at that seems to be more successful and is a little bit further on in their journey and has made some sales, I think that would be really interesting for us, because now we can start to have some contextual reference. But until the next video, thank you, Ted. Thank you to everyone.
Don't forget to add the comments. So if you know more about this company, if they've they've signed a deal, you know what's going on, then please do add your knowledge to in the comments.
Absolutely. Yeah. Great company to analyze. And yeah, until the next video, thank you again, Ted, for a great one.